Stock Study Sundays, August 9th, 2026, Terry Randolph. Today, what we're going to get into more so over the charts or any market news is some of the foundational things that makes up the market and what it consists of, because some of these things impact our lives on a daily basis on many different areas, and we're not really aware of it. But with a better understanding, we can make better financial decisions as well as investment decisions. This is not investment advice. This is just informational purposes only. So what we're going to get into is, what does the financial system consist of? It is various things. The first thing is households. Households, because you have a lot of things. When you get up in the morning, you're doing business with roughly 8 to 9 people, and that's even before you walk out the door. You're laying on a certain mattress, you're laying on furniture. You roll over when you wake up, you check your phone or look at your alarm clock. You got an iPhone or maybe a Android, Google. All of those is publicly traded. You go to the bathroom, turn on your water to brush your teeth, or you use the bathroom, you use the toilet. Those are your public utilities, which is in some aspect controlled by the government or influenced by the government. Turn on your coffee maker, or you might turn on the news to check the weather. Your media companies, iHeartRadio, maybe YouTube. You might have Bloomberg News. Spotify, you might listen to your music on your way to work or your favorite podcast. A lot of those is publicly traded. Or you might stop and get your coffee. You might go to your Starbucks. You might go to your Tim Hortons. You might go to McDonald's or what have you. You're driving up a public highway, which is funded by government tax dollars. Hell, you might stop at the ATM to get some money out. You might Zelle some money, put a few extra dollars in your account or something like that you got to send. You got a Chevrolet, you got a General Motors vehicle in your driveway. You got a Ford, maybe you got a Tesla, maybe you got a Toyota. You might got a Mercedes-Benz or a BMW. All of these are publicly traded companies, in some way controlled by, their businesses. They're regulated by the government, and they benefit or funded by some way through the financial institutions. Now let's get into securities. Securities. Financial instruments that represent obligations on the part of the issuer to provide the purchaser with expected stated returns on the funds invested or loaned. Stated returns on the funds invested or loaned. Securities are grouped in 3 categories: money market instruments, bonds, and stocks. Money market instruments and bonds are debt securities. Stocks are units of ownership in a business. So most of these companies, you can buy units of ownership, or you can buy shares in a lot of these corporations to get an expected return on the money invested. So, you put $1,000 in some of these companies, 5, 10,000, or whatever it may be, you're expecting to get a return on it. But they take that money and invest it in the things they need to do to get the company to grow or bring forward your goods and your services. Then you have money market instruments. What is money market instruments? Short-term debt securities issued by governments, financial institutions, and corporations. Mature within 1 year from the date of issue. Pays interest to the investor for the use of their funds. So it's pretty much like your debt or your credit markets. So let's just say you give somebody $1,000 and they say, hey, I give you 10% for 1 year at 10% interest. So pretty much what they do is they pay you interest for that 12 months that they're holding your money that they're investing, and then they return that principal a year later. So you're getting a 10% return for loaning them your money. That's how your bonds work, your money markets, and that's a lot of your credit markets. Generally, low-risk securities are purchased by investors with surplus cash. Examples: U.S. Treasury bills, which are T-bills. That's how the government is financed. Commercial paper and bank CODs. Let's go to your T-bills. T-bills, short-term securities from the United States Treasury. backed by the full faith and credit of the United States government. The full faith and credit of the United States government. That's a big bankroll. So when you go outside, you're on your way to work, get on that highway, you're on your way to the office or wherever you're going. You're on your way out to the airport, wherever it might be. There's millions on top of millions, hundreds of millions of people involved in economic activity. All that economic activity consists of taxes. People are getting taxes taken out their paycheck weekly on a bi-weekly basis. You got business, you got to pay taxes on the business. You got sales taxes. So hundreds of millions, you got tons of folks paying taxes. That's why the U.S. government never defaults on its debt. That's a big bankroll. You're talking about almost a $70 to $80 trillion bankroll. Then not only that, you got folks from other countries that buy UST bills and bonds, U.S. bonds, because they know that they don't default. It's a good credit rating. Sold in 30, 90, 180, and 360 days, and the minimum denominations of $1,000. You got commercial paper, sold by corporations, 1 to 270 days of issues. Certificate of deposits. Certificate of deposits are offered by commercial banks, saving banks, and credit unions. Denominations of $250,000 or less. So $250,000 is the max. I think the less you can buy them for, I believe you can get them shit less is $100 to $200, I believe. And they usually give you like 90-day CODs, 6-month CODs, 1-year CODs. Bonds. Bondholders are creditors of a corporation or government body. Comes in varied denominations from $1,000 to $25,000. And actually, the bond market is one of the biggest markets next to the Forex. The bond market is actually bigger than the stock market because usually everything that you're looking at is financed. Even the government is financed. A lot of people don't know. The government is financed, dog. That's why you got the Federal Reserve, They buy the T-bills. And then the government, what they do is, roads got to be built. Street lights got to be put up. All your telecommunication systems so they can communicate, satellite, your Wi-Fi, your internet, all your infrastructure, bridges, docks, because we trade with other countries, goods coming abroad, they're being imported, exported. All of that stuff is financed. When you look at somebody's house, it's very rare that somebody's going to pay cash for a house. Not to say that people don't, but in most cases, people are buying mortgages. Same thing with cars. People are usually financing their cars or leasing their cars. That's the bond market. The rate of interest is the income paid to the bondholder. They have a claim on the company's assets to be satisfied before the stockholders in the event of bankruptcy, reorganization, or liquidation. So pretty much if they loan you the money, anything you buy or you purchase, they get a claim on it first before any of the shareholders or the people that get equity in the company. The types of bonds. You got government bonds, you got municipal bonds, they call it munis, and corporate bonds. Most of your city halls, your town hall roads, your schools, your libraries, local roads, streets, and stuff like that. A lot of that is funded with munis, municipal bonds. Munis can be paid by way of toll roads, bridges, or the power to levy taxes. The interest points are exempt from federal taxes. Mortgage pass-through security backed by a pool of mortgage loans purchased from lenders, such as savings banks. And then even they have credit ratings. It's just like you got a credit score. A lot of the companies that issue bonds, they got credit ratings too. You got AAA, you got BBB, BR, lower risk, investment grade, speculative, and junk. Straight junk. So that means that they get that credit. They got junk bond. That means that credit is terrible. And you taking a big chance. You might lose it. If you give them some money, that's like looking at somebody that got a 480 credit score. You loan them some money, you taking a big risk because they usually don't pay nobody back. You know, they hopping from job to job, or they don't pay their bills on time. If they pay their bills at all, then they defaulted on almost everything and then gave them. Bond prices are predicated on the market interest rate. That's the rate the Federal Reserve Bank sets at the Fed meetings. So Jerome Powell is no longer in there. We got Kevin Warsh. So when Kevin Warsh had a Fed meeting, that might have been one of the reasons that Donald Trump wanted to get him in there. So maybe he can induce him or entice him to some degree to drop rates. And that way it can stimulate the housing market. The housing market is heavily predicated on your interest rates. When the interest rates drop, it stimulates the market because, you know, it's cheaper to borrow money. And it also makes the rate of the asset go up because with the money being so cheap, and it makes the asset price go up. But it also stimulates the market. The rate the Federal Reserve Bank sets at Fed meetings. Then we got financial markets. Markets in which financial securities are issued and traded, bought and sold. So the markets is a lot of supply and demand, just like anything. You know, you got a housing market, you got a car market, you got a wheat market. So you got financial markets also. So it's like stocks. Stocks is demanded. So, you know, supply, demand, bonds. You got your bond markets, everything we just went over. All those is on the public markets, publicly traded markets. So you got primary markets. Primary markets, financial markets in which companies and governments issue securities and sell them initially to the general public. A lot of people think that they are buying from the primary markets, but they're not. They're actually purchasing from the secondary markets. It's from what's called market makers. So on the primary markets, let's just say company ABC or XYZ needs to raise money to do whatever they need to raise, and they want to take it public. They go to the investment banker. The investment banker writes up the prospectus or whatever, and he takes it to the bankers, your Merrill Lynch's, your Goldman Sachs, Morgan Stanley of the like, and they sell it to them at a set price, and then they take it to the premium. They might go for $8 a share, then they take it to your secondary markets, $10, $11, $12 a share. When a company needs capital to purchase inventory, expand a plant, make major investments, acquire another company, or pursue other business goals, it may sell a bond or do a stock issue to the investing public. Securities are sold to the public in two ways: open auctions and investment bankers. Sales of most corporate and municipal securities are made via financial institutions such as Morgan Stanley, Merrill Lynch, Goldman Sachs, etc. They purchase from the company or government and resell to the investor. The process is called underwriting. A lot of people, when they come to mind, they think of maybe their mortgage being underwritten or insurance underwriters, but they also underwrite sales of securities and bonds also. The secondary market. This is where most of your investors or stock traders purchase from. It's the secondary market. Collection of financial markets in which previously issued securities are traded among investors. Sorry for the typo. Corporations and governments that issue securities traded aren't directly involved in secondary markets. They make no payment or receive proceeds when securities are purchased. The New York Stock Exchange, American Stock Exchange, the Russell, Nikkei, NASDAQ are examples of secondary markets. Usually these are purchased on Charles Schwab, Fidelity, your Robinhoods, Webull, accounts like that. So you can open up one of those accounts, and from there, you can purchase whatever you want to purchase. You want to purchase Five Below stock. You want to purchase Amazon. You want to purchase Netflix. You can do it on your Robinhood account, your Webull account, whatever. You can do options trading on there, whatever you want to get into. Your market order. Best possible price, the highest price when selling and the lowest price when buying. Limit order sets a price ceiling when buying or a price floor when selling. You will see that on your app if you download it. It gives you those options. Let's go to your commercial banks. This is where it gets interesting in. Everybody you look at, everybody you go past, usually they got a bank account of some sort. You drive past and they got a debit card, credit card, something in their pocket. Now look at this. In this where, they tell you that it's a recession out here or the economy is tight, it ain't no money and all that. That's foolishness. A lot of that is to persuade most people that don't know any better to accept the inferior position of going to work for minimum wage, $15, $16, $17, $18 an hour, working hard. Because if they knew what was really going on, how much money was in the situation, or what was at afoot, they really wouldn't accept that. So let's look at this. Commercial banks. Total assets of more than $25.6 trillion. Let that sink in for a minute. Total assets of more than $25.6 trillion. Banks offer the most services of any financial institution. Checking, savings, deposit accounts, consumer loans, credit cards, home mortgage loans, business loans, and trust services. Banks raise funds offering a variety of checking and savings deposits to customers. They pool these deposits and lend them, most, in consumer and business loans. So that $5,000 that you put in the bank, they take that $5,000 and they can issue it out 9 times at whatever the prime interest rate at. So they just got to keep usually $1,000 on deposit and they can issue out the whole 5. Credit cards, auto loans, stuff. So at 5, they can issue out $45,000 off your money. Banks make money from charging higher interest on loans than they pay on deposits, along with other fees. Not to mention, they are also publicly traded banks, so they sell shares of the stock also. Isn't that something? Now here's something. If you got a bankroll, you got the FDIC, the Federal Deposit Insurance Company. They insure up to $250,000 of depositors' money. So if you got a couple of million, or even if you got $1 million, let's just say, hell, even if you got $750,000, they only insuring $250,000 of that money. So that's why you have to spread your money around a little bit. If you got more than that, or you got to go to an institution, get your money market account or something like that. If you got more than $250K laying around, so you don't take that loss, because that's the only thing they're gonna guarantee if something go wrong with the bank. If there's a run on the bank, they go out of business of some sort, something happen, hey, they only give you $250K, bro. Savings and loans are mainly for mortgages and don't really loan to businesses, same as credit unions. Assets are around $1.26 trillion. Credit unions are estimated at $2.43 trillion. There are roughly about 8,000 credit unions. You got roughly about 15,000 banks in the U.S. Then you also got banks that's outside of the U.S. that offer banking services in the U.S. Then it goes to your non-depository institutions, your insurance companies, pension funds, and finance companies. Your insurance companies, think about this for a minute. Every car you drive past, it's insured. They paying insurance on a monthly basis. You got homeowners insurance. You got life insurance. You got health, dental insurance. People paying this stuff on a monthly basis. A lot of times, especially with your homeowners or your auto insurance, they give you hell and hot water paying out your premium. So, you paying this on it. You got people that's been paying insurance for 10, 15 years. They ain't made a claim not once. Insurance companies assume the risk, pay operating costs, and invest the difference. Insurance companies are a major source of funds, short-term and long-term financing for businesses. A lot of people don't even know that you can go to insurance companies and borrow money, or if you got a life insurance policy, you can borrow against that. The total cash and invested assets is $9.6 trillion. $9.6 trillion. Insurance companies are big fun. A lot of your skyscrapers and big buildings and stuff like that you see, stuff is funded by your insurance companies and your pension funds. Pension funds provide retirement benefits, long-term predictable cash flows and outflows. They invest heavy in assets such as common stocks and real estates. Total estimate of $6.2 trillion in assets. Those are your pension funds. And the reason they do real estate, REITs and stuff like that, because it's a steady income, steady predictable income. And a lot of them is involved in your institutional investing. So they buying large shares of some heavy companies, your Mag 7s and stuff like that. Then you go to your finance companies, Ford Motor Credit, your GMAC, your John Deere Corporation, a lot of your major construction companies and stuff like that get contracts with the government. You know, they might get a finance through John Deere, Caterpillar, and the like. They provide short-term loans to borrowers, pledge assets such as inventory, accounts receivables, machinery, or property as collateral for the loan. They raise funds by selling securities or loans from commercial banks. Then you got your mutual funds and your ETFs. Also like 401ks. You know, people got 401ks at their job that they just say, hey, they match me. Yeah, okay, they match you. But what are they taking your money and investing in? What is their assets under management? What is their capital allocation and their spread? A lot of people don't understand this stuff. They just know that hey, I got a 401k. 401k, financial intermediaries that raise money from investors by selling shares, mainly 401k and retirement plans. They have, what happened here? Take that down. They have more than an estimated $32 trillion in assets. It's a big bankroll. Federal Reserve is the head honcho. They are the central bank of the United States. Yes, the government has a bank that they bank with, that they get funded by, that they get financed by. They print the money. They issue the money. They got 4 responsibilities: regulating commercial banks and banks-related activities for the United States. So listen, banks borrow money. A lot of people don't know that the bank, you go to borrow money from the bank borrow money from the Federal Reserve. They got Treasury, services for banks, and they set monetary policy. They the one that dictate how money is issued and flows. They print the money. They issue the digits on the screen. Membership is optional for state chartered banks. So your the little local yokels is optional. You know, we ain't talking about your JP Morgan Chases, your Bank of Americas, your Citibanks, U.S. banks, Wells Fargo. We're not talking about them. We're talking about your little local yokels, your Americas and stuff like that. Frost Bank, Flagstar, of the like. They have a board of governors, a chair, a vice chair, appointed by the president and confirmed by the Senate. So our last 2 Fed chairs, Donald Trump appointed them. He appointed Jerome Powell. I guess that's why he's trying to get him removed. He appointed him, and I guess he wasn't trying to succumb to the Donald Trump influence and just bend him by his will. But again, they are an independent agency. People think because it got the word federal in it that it's controlled by the government, but it's not actually controlled by the government because it's an independent agency. They're confirmed by the Senate. So once Jerome Powell's seat was up, he appointed Kevin Warsh, and he had to be confirmed by the Senate. The most important function is controlling the supply of money and credit. The supply of money and credit. So they issue out the money and they determine what the interest rate for the your member banks is. That's why it impacts all of us, because once they set the rate, that rate is going to determine pretty much everything in the economy. What your mortgage rates is set at, what's your interest rate for your mortgage, your auto loans, everything you can think of. Even your job, the companies you work for, that interest rate is going to impact them because a lot of your companies are borrowing money. So if they got fluctuating interest rates, it costs higher for them to borrow. And look, they might have to lay people off because their borrowing cost is higher. Business might slow down because, the people that they're buying supplies and stuff like that come from, that cost is higher, all based on interest rates. M1 consists of money in circulation and balances in the bank. M2 equal M1 balances in some money market and mutual funds. So that's pretty much the foundation of the financial system in your financial markets that impacts us in various ways. We wanted to go over that so we can pretty much get a foundation of what makes up the market, how these things impact our lives, impacts our financial decision, our business decision, and all other things around us. With a better understanding of things, we can make better decisions and have a more financial, prosperous life. If you're working day to day and still struggling to make ends meet, are you dealing with job insecurity? Is your paycheck not keeping up with the rate of inflation? Or do you just want to make some extra income on the side to supplement what you're making to be able to do additional things? Reach out to me. I might have a solution for your problem. I do live option trading and I do stock trading courses. Terry Randolph, Stock Study Sundays. Holla at me.